Hello, everyone. Professor Reiko here again today, and we're continuing on with our chapter on cash and receivables. So this is our fourth video, and now we're getting into the valuation of accounts receivable. All right, how we go about valuing them on our balance sheet, accounting for any amounts we might expect not to collect. All right, so let's get into all that. All right, so if a receivable is deemed to be uncollectible, it must be written off. All right, anytime you see the terms write off, written off, it means take it to zero, that account. All right, so if we have a accounts receivable for a certain customer and we say that and we're writing off their account, we'll make their account zero, not the entire accounts receivable balance, just their specific accounts receivable balance. All right, so there's two primary ways. All right, we see the direct write-off method here, and then down here we get into the allowance methods. We'll talk about that in a second. All right, so this is the direct write-off. When we find an account to be uncollectible, it is written off with this journal entry right here. Bad debt expense, okay, so that would go to the income statement as an expense, and the accounts receivable would be makes, like I was saying, their individual AR account zero. Okay, it writes it off. So that credit to accounts receivable reduces that account to zero. All right, but if you notice here, kind of just star this, the direct write-off method is not GAAP because generally the establishment of the receivable and the write-off, this journal entry right here, is in a different accounting period. Now remember, we always want to, if when possible, we want to have the revenues and the expenses associated with those revenues in the same time period. All right, so if we had these, so if we think about it up here, we have accounts receivable, sales revenue. All right, and then we have this journal entry here. So if this is 2017 and this is 2018, we have the revenue in 2017 and the expense in 2018. Okay, so therefore we're not putting things in the correct time period. All right, so if you see there, that's what this paragraph is talking about, because it's not going to put them in the correct time period. It also fails to record accounts receivable at the net realizable value because we haven't accounted for this account that's going to be written off. And so therefore we will default to the allowance method. However, notice here it says the direct write-off method is still used for tax purposes, especially when people are more on the cash basis of tax, but we won't get into that because this is not a tax class. So we want to focus our attention, and I'm sure your teacher will as well, on the allowance method. Now look, we are still going to record bad debt expense. We're just now going to record it in the period of the sale. So up here, these two journal entries will be in the same time period. And then when we write off an account, we'll still make accounts receivable go zero, but we'll do that in when we actually are going to write off the specific account. So you'll see we'll just basically break up the bad debt expense and the accounts receivable portions of that journal entry. The bad debt expense will be in the period of the sale. The credit to accounts receivable will happen when we actually write it off, assuming it's a future accounting period. So if you scroll down here, notice it says the allowance method uses an estimation. Okay, so we don't know the exact amount. We're going to estimate the amount of accounts that are expected to go bad. Meaning go bad is we mean they're not going to pay us. Okay, we sell all this stuff on account. Not everybody is going to pay us. People will go bankrupt. People will skip town. Whatever the case may be, not everybody is going to pay us. All right. So from this, an allowance account is set up. That's why this is called the allowance method. Okay. Then when we are deem an account to be uncollectible, it will be taken away from the balance of the allowance. Okay. What this allows us to do is establish the allowance. Okay. So this is the period of sale. So notice up at the top of the page, it was not the period of sale. We did the expense in one period. We did the expense in the future period when we wrote things off. So we now have this allowance for doubtful account. All right, so essentially this is just going to be an adjusting journal entry at the end of the period, whatever accounting period you're looking at, month, quarter, year. Typically, a lot of times in these classes, you'll be looking at a year basis. All right, so that's in the period of sale. All right, now the entry to write it off, all right, the account, once it has been identified, we take it away from the allowance, all right, and write off the accounts receivable. So once again, as I was saying up top, we still have the bad debt expense component, and the accounts receivable component, they're just broken up to where we have the expense in the period of sale, so it's in the period of the revenue, and then the accounts receivable goes to zero. Like I said, this will now be zero when we actually write off the accounts receivable for that specific account. All right. So 2 entries, bad debt expense. All right. For the most part, this journal entry, adjusting journal entry, is what you're going to be focused on. All right. And then you'll probably have some examples where you actually do the actual write-off and maybe reinstate an account. We'll do that as well. All right. So the allowance for doubtful accounts is a contra asset account. Okay. That, remember, contra asset. That's why we see up here when we first establish it right here, it's a credit balance. Okay. And assets are debit balance. Contra asset would be a credit balance. All right, so it's used to offset the accounts receivable balance to get the net value that we expect to realize. All right, so the net realizable value is the accounts receivable less the allowance for doubtful accounts. All right, if you think about it, essentially what it's saying is the number on, that's messy. Hang on a second. The number on the balance sheet equals the asset minus the contra asset. All right. So for accounts receivable, it's the net realizable value. That's the number that goes on the balance sheet. It's the accounts receivable balance less the allowance. I mean, if you think about fixed assets, which we'll do in a little bit, but we've talked about, you would have talked about this in your financial accounting. The book value of the asset goes on to the financial statements, the balance sheet, and that is going to be the historical cost of the asset less the accumulated depreciation, which is the contra asset account. So it's the same thing conceptually. Asset less contra asset gives me the number that goes on the balance sheet. All right, so if we look up here, gross accounts receivable of 100, allowance of 7, we're going to have a balance of 93 as our net realizable value, right? So going over here to this next page. Now, if somebody pays us off, or pays us, I should say, after we wrote off, meaning we already wrote off their account, but then they turn around and pay us. That could happen, all right? It's probably rare, but it could happen. If that happens, we must reinstate their accounts receivable balance for that customer and then show the collection of the cash. So 2 separate entries. All right, so notice this journal entry right here. This reverses the prior entry, the one we just did, where we wrote off the account. So that reinstates it. Okay, and then this one is the collection of the cash, all right, which is a journal entry you would have done before, even back in financial accounting. All right, so that's rare, but if they do pay us off, let's just reinstate their account, reinstate the allowance, and then show the cash is being received. All right, so there's 2 different ways to estimate the allowance, okay, using the percentage of receivables approach. There's a composite rate where companies simply multiply their receivable balance by a rate to get an estimate as what is uncollectible, okay? Or what you'll see more often is an aging accounts receivable, all right? So that each accounts receivable balance is classified by their age. Are they current? Are they past, they 1 to 30 days, or they're 31 to 60, 61 to 90, and so forth. And then what we'll see is we'll apply a percentage to each of those to get the total dollar amount that is expected to be uncollectible. Okay, so we're still getting a percent, and we're still going to establish our allowance. All right, but we'll just have different buckets, is kind of what I refer to them as, to establish what our allowance is going to be at the end of each year. All right. However, it's important to note, regardless of which method used, the amount calculated needs to be the ending balance in the allowance for doubtful accounts count at the end of the period. This means, this is important right here, this is often missed, you must account for the beginning balance when preparing the adjusting journal entry. So remember on the previous page, the adjusting journal entry is my debit to bad debt expense and my credit to the allowance, okay? So that's going to be my journal entry. The issue is, what number do we put in that journal entry? The journal entry number is the number that gets me from my beginning balance to my ending balance that I'm going to calculate. So I'm going to calculate my ending balance. All right, so if you think about a T account for the allowance, all right, let's just assuming it's a credit balance. Here's my beginning balance. And let's just say it's 8. And then my ending balance, we do an aging of accounts receivable, and we determine that's 10. Well, my adjusting journal entry is going to credit that for 2 to make it go up to 10, right? So we'll see that when we start doing examples, right? But that's an important, a lot of times students forget to put that beginning balance in the problem, and then they have the wrong number in their journal entry. Okay, so I'm sure your teacher will stress that as well, and I want to stress it here, so make sure you pay attention to that. All right, so tune in, keep tuning in. We're going to do some examples and talk about notes receivable and things like that in the upcoming videos. But this kind of gets us through the all the concepts and what the journal entries are going to look like, and then we can just start throwing numbers into this process. So hopefully this helps. Keep tuning in. Please subscribe to the channel. It does help me, and I will see you next time. Thanks.